Welcome to another tutorial video. This time we're going to be discussing how to pitch a stock and cover our stock pitch guide as well as the company selection and research process. This video corresponds to an M&I blog post called Stock Pitch Guide. You can go visit it down below on the screen, just mergersandinquisitions.com/stock-pitch-guide. And you can get some templates there, the full guide in text. We're going to expand on the article here and focus more on the idea generation part, and in particular, how you can come up with ideas for stock pitches and screen companies when it's the last minute and you don't have much time left. So the plan for this tutorial will be to cover the basic stock pitch structure first, which you're probably already familiar with, but we'll go through it quickly and give you a few samples and templates. Then in part 2, we'll talk about idea generation. How can you find ideas if it's the last minute and you only have 2 or 3 days, or maybe 5, 6, or 7 days to prepare for an interview at a hedge fund or asset management firm? And then in part 3, we'll discuss the research and valuation process, how you can do it efficiently, how to find your angle, and how to get the key inputs for your stock pitch, including the complexity of the model and valuation analysis that you come up with, and the ideal length, and how to make it complex enough without going overboard and coming up with something that takes too much time to research and finish. Let's go to part 1 first and talk about the basic stock pitch structure. Now, this is something that we've covered extensively on the site over the years, so you can go through and look at the text version of this as well, but you always want to start a stock pitch with a recommendation where you long or short the company and you say what it should be worth according to your analysis. In our example on the site for Jazz Pharmaceuticals, we have a recommendation slide here. We short the company, we present our investment thesis and explain why the market is wrong about its valuation, and then give what we think it should be worth, why we think its stock price will change, what the risk factors are, and how we can mitigate some of those risks. Then in the next section, you give the company background. You describe its products, services, market, its approximate revenue, EBITDA, market cap, and valuation multiples. For Jazz Pharmaceuticals, we do just that. We also include a price volume chart over the past year from before the stock pitch for good measure. And we explain a little bit about what the long-term projections in our base case scenario here look like. Then in part 3, you go through the investment thesis and you explain why the stock is mispriced and why the market hasn't factored this in and adjusted to the correct price. So here we have 3 main reasons. The threat of generics to one of the company's key product lines. We think the company's ability to raise prices will be quite limited. And we think that some of its new experimental products or drugs will have lower than expected potential. In the next part, you give catalysts, key events in the next 6 to 12 months that will cause the market to realize its mistake and result in a pricing correction. So for Jazz Pharmaceuticals, we have the FDA approval of some of those generic drugs. We have the fact that when the company announces earnings, everyone's going to realize that it is simply not raising prices on its key drugs as much as it did in the past. And then we also have early sales results from some of these more experimental and earlier stage products. Then in part 5, you go through the valuation and paste in your DCF analysis, comparable companies, and whatever other analysis you have to show why the stock is undervalued or overvalued. You can see our example here for Jazz. We have a football field valuation chart. We have a summary of our assumptions for the DCF, and we also have some sensitivity tables showing why we think the company is at best appropriately valued right now and actually significantly overvalued according to our views. And then we go through the risk factors and mitigants and how we could reduce some of the risk or limit our losses if we're completely wrong. And you can see it here. We basically reverse the catalysts and say that maybe the generics will enter later than expected, maybe some of the new drugs will perform better than expected, and maybe some other products will gain positive clinical trial data. And we can mitigate some of these risks with call options or stop loss or stop limit orders. And overall, we say that we limit our potential losses here to about 15 to 20%. And then at the end, we just give a summary and show all of our recommendations here once again. So that's the basic structure for a stock pitch. Again, you can go through the entire M&I article and read through all this in text format and get some screenshots of everything for a couple different companies here as well. What I want to focus on now is the idea generation process. What if you only have a few days, you're not following the markets or specific companies closely, and you need an idea for an upcoming interview as soon as possible? The first step in this process is you need to figure out what strategy the firm you're going to interview with uses and then which industries it likes and does not like. There are a couple ways you can do that. You can, of course, try to look on their website. You can ask someone there about their strategies. You can try to find their holdings in SEC filings. So there are a couple different ways you can do this, but you need to figure this out first. Because, for example, if you're going to interview with a value-oriented long-only fund that likes industrial companies, then you want to focus on companies in industrials or related sectors. So maybe manufacturing or chemicals or even retail, but something that is a bit more mature and is based a little bit more on hard assets. You don't want to go in and pitch a short for an overpriced biotech startup if the fund only does long investments and focuses on undervalued companies. And then you want to match the industry to something that lends itself to the hedge fund's strategy, or pick an industry that you know something about. So let's keep going with this industrials example, and we'll say industrial goods for the sector and then industrial equipment for the industry. And I'll go on FinViz right here. And for sector, I'll say industrial goods. And then for industry, I will say industrial equipment and components. So we have those two for the screening criteria. And so we get a set of 12 companies based on that. Now, how do you screen and narrow down this list once you have the set of 12 companies? First off, you want to focus on mid-sized companies in the industry, ideally ones that are in roughly the $1 to $10 billion market cap range if you're working with US-based companies. If you're doing this based on revenue, maybe something with hundreds of millions of revenue to perhaps the low billions. So you get mid-sized companies in the industry. You don't want to pick giant conglomerate companies. You also don't want to pick micro-cap companies because they both have different problems and tend to be harder to use in stock pitches. You also want to look for companies where there's been a clear divergence from the stock price trends overall over the past few months. So maybe the entire market has gone up, but one company has stayed the same or even decreased. Or it's the opposite and the entire market has gone down, but one company has stayed the same or gone up. So with this example for our industrial screen here, first off, we'd probably eliminate the top two companies at the top. One is in the UK, so it's not great if we're in the US. The other company is just too big. And then we'd probably also eliminate some of these companies at the bottom because they're well below $1 billion in terms of market cap, which leaves us with roughly this set of companies, 5, 6, or 7 or so in the middle. If we look at these companies' share prices, for the most part, they have increased pretty substantially in the past 3, 4, 5, 6 months, something in that time range. However, there are a few that stand out as not having increased by that much. One clear example of that is Barnes Group right here. Its stock price fell pretty dramatically the year before, and then even this year, it stayed basically the same even as everything else in the sector has gone up. The other one that stands out is TriMas Corporation. Here, it did increase the year prior to this, but this year it's been roughly flat except for a quick increase right in the beginning in January. And then if we want to expand this a little bit more, we could also look at Standex Corporation, which has been relatively flat so far this year. So if you look at all these and you look at something like this, where maybe the company decreased a lot last year, stayed flat this year, even as the sector as a whole has gone up, you get some ideas for companies that may not quite be following trends and might be a bit different from everything else in the industry. So as I say, we think that Barnes Group, Standex Group, and TriMas here are probably the best bets for our initial screen. Now, the next two steps 4 and 5, because I'm grouping them together, are that you want to find companies with only a few key drivers and relatively pure play businesses, as well as clean and simple financial statements. So you don't want a company with 20 different product lines where each one is, say, 5% of the revenue. You want a company that has maybe 2 to 3 major segments and well-defined key drivers. And you don't want a company that has, say, 50 items on its cash flow statement. You want relatively short and simple financial statements. So if we look at all these companies, starting with Barnes Group, its income statement here is fairly simple and straightforward. If we go down to its balance sheet, everything here is also pretty straightforward. These are all the standard items you'd expect: cash, debt, equity, receivables, inventory. Nothing too crazy here. And its cash flow statement, we'd say, is also pretty straightforward with exactly the items that you'd normally expect for a standard company. If we go to TriMas, again, its balance sheet is pretty standard and straightforward. Same for its income statement. And moving down, its cash flow statement looks a little bit more complicated on the surface, but it's actually not that much more complex than Barnes Group's. And then finally, if we look at Standex, its balance sheet is similar, maybe a little bit more complicated. Its income statement also looks fairly straightforward. And then if we go down, its cash flow statement is also straightforward, although there are some more items here. Maybe it's a little bit more complex than the others. However, the real point here is that the financial statements are not that much different, but Standex appears to have more segments than the others, and that is going to make the research and valuation process take more time. To illustrate what I mean here, let's just go up and do a search for one of the numbers in that screenshot. So if you look at a summary of the company's operations, they have a food service equipment segment, an engraving segment, an engineering technology segment, and an electronics and hydraulics segment. 2 separate segments there, actually. And there are some that are bigger than others. The food service equipment one is the dominant segment, but it's not as if one segment has 90% of the company's revenue. It's more like maybe close to a 40 to 50% split for the food service equipment one. So we have quite a few segments here. By contrast, if we look at something like the Barnes Group, for example, and let's just go down to where they have their split. I'm searching for aerospace because I know already that's what one of the major segments is. They basically have 2 segments, industrial and aerospace. And if you go down a little bit and you look at financial performance by business segment, they have industrial, they have the sales and operating profit and operating margin. And then if you go down, they have aerospace and the sales and operating profit and operating margin. And beyond that, they don't really have much of anything. So they just have 2 simple segments right here. And if you go to TriMas, you'll see something similar. So based on this quick screen, we'd probably narrow this further to Barnes Group and TriMas. Barnes Group has 2 main segments, TriMas has 3 main segments. And so now the final step to pick a winner here and to decide is that you generally want to favor companies with clear catalysts in the next 6 to 12 months, such as an announced acquisition or divestiture, a major product launch, a major expansion plan, a strategic change, something like that. And if we go and look at TriMas's investor presentations and other sources, we do see something that looks promising at first glance, a recent acquisition announcement for this company, Plastic SRL, which is based in Italy. However, if we keep reading, we see that its annual revenue is only about 12 million here. And if we look at TriMas's revenue for the company as a whole, it's close to 900 million. So no matter how you slice it, a 10 or 12 million revenue company is just not going to contribute that much to something that is almost 100 times the size. Based on that, we would say that TriMas here is probably not the best one. If you look through, there are a couple other potential catalysts, but overall, we think that the Barnes Group is probably a better candidate for a couple of reasons. If you look in their investor presentation, for example, one key slide here is that they give their major portfolio shifts over the last several years, and they explain where they were before and then where they are now, which implies that the company is changing by a good amount. Also, if you look throughout this, you'll see that there's some pretty clear references to their growth areas. For example, if we could do a search for automation right here, they list it as one of their key growth drivers and as one of the key macro factors. And then if we keep going, they say that they launched automation in 2018, established force and motion control in 2019. So these are clearly segments on the rise. And if we keep going, you'll see that here, automation is only about 1% of revenue right now, but it's growing very quickly by double digits, which means that something relating to the company here is changing. The other thing with Barnes Group is that they do have high exposure to aerospace. About 34% of its revenue comes from it. Just before I created this tutorial, there was big news about Boeing and several fatal accidents forcing the company to ground their 737 MAX aircraft. Right after those announcements, the Barnes Group's share price fell by about 10% when the aircraft was grounded, presumably because investors know this and they're worried about their exposure to Boeing. But if you look later on in the presentation, you'll see that yes, they have some exposure. They're making some parts relating to the 737 MAX, but it's actually much less of a focus for the company than all the other Airbus and Boeing aircraft. So we could make some type of argument that the company might have been unfairly penalized for its aerospace exposure here. That's part 2, the idea selection process and how we came to the conclusion of using the Barnes Group here. Let's now go through the research and valuation process. You want to do 4 basic things here. First is research the company in the industry by getting the annual and interim reports, the latest investor presentation, and recent press releases. Then you can build a simple DCF-based valuation. Don't go overboard. You want to project revenue and expenses beyond simple percentage growth rates and margins, maybe go down to units sold, average selling price, or market share times market size, and aim for around 100 to 300 rows in Excel. If you've seen our DCF example for Steel Dynamics, where we split up its sales into 3 main segments and a couple smaller ones, something like this would be reasonable for a stock pitch, where we get up to around 150 or so rows here. You don't want 5,000 rows. You want something in that range. We'd say 100 to 300 rows in Excel for your projections and DCF analysis. And then for the public comps, you could use FinViz or Google Finance to save time there. Take a look at our comparable company analysis tutorial for more on that one. And then you also want to do some real life research. So speak with people in real life for a few hours. Find some suppliers, customers, others on LinkedIn, email them, and offer your insights as an investor into their company in exchange for maybe 10 minutes of their time to answer a few questions that you might have had about the company or the industry as a whole. So here we already have the reports, and we actually already have the peer companies, because when we did our FinViz screen, this also gave us some of the peer companies that we could use. So we already have that part done. We just need to pull the financial information for them. Our first step would be to set up the DCF analysis and make the main splits between aerospace and industrial on a revenue and operating income basis. And then we'd go beyond that if possible. Maybe it would be units sold, maybe it would be market share, maybe it would be the backlog growth and the backlog delivered. It can be a little bit tricky in this sector to go below revenue growth and operating margin by product line, but with enough research and going through the filings and doing some online research for the market, we might be able to do that. And then for the real life research, Barnes Group mentions General Electric, Rolls-Royce, and United Technologies in its filings. All those seem pretty important, so we'd probably start there and then start looking for some possible contacts on LinkedIn. And if we ran out of time, maybe we can only speak with 1 or 2 people or contact 1 or 2 people, but it's still a whole lot better than nothing. The angle here would probably be something to do with the market over penalizing it because of its exposure to Boeing, maybe underestimating its automation segment, and maybe also underestimating its margin expansion potential. If the automation segment really takes off, presumably its margins will go up because automating tasks is cheaper than hiring humans to complete them. Or we could take the opposite view, and maybe we'll say that it should fall by even more than it already has. It just depends on the results of this process and what we find when we speak with people and do our market research. The catalyst here could be backlog updates, announcements related to Boeing, earnings announcements that have some of the automation segment results, and maybe potentially acquisitions as well. With the valuation, we can't really say anything because this was intended to be a quick tutorial showing you what to do with limited time. Setting up a whole DCF here would take more time, and I don't have it, and I'm not going to show it here, but you would do that and draw some conclusions, ideally building in cases like the base case, upside case, and downside case to reflect your views, what the market is thinking, and then what you think will actually happen. That's it for a tutorial. To do a quick summary now, the stock pitch structure is that you always want to start with your recommendation, long or short, what the company should actually be worth, why it's mispriced right now, and why it's going to change. Then you give some company background information. Then you go into your investment thesis and explain why it's mispriced and why others have overlooked it. Then you go into the valuation and explain what you think it should be worth. Then you give the catalyst and explain why its stock price will change over the next 6 to 12 months. And then you give the risk factors and explain how to mitigate some of the risks. For the idea generation, we recommend picking an industry that matches the strategy and industry focus of the firm you're interviewing with, and also something that you ideally know a little bit about. Once you have that, then you can go on a site like FinViz and screen for mid-sized companies in the industry. Focus on ones that only have a few key drivers and relatively clean to financial statements and relatively easy to understand businesses. Once you have that, then look for companies that have clear catalysts in the next 6 to 12 months and are changing in some way, because those will be better and easier to discuss. And then finally, for the research and valuation process, get the company's annual and interim reports, a few recent press releases. Start building a simple DCF and valuation analysis using the peer company data that you found before on sites like FinViz, and use a very simple template, and then go out and try to speak with people in real life if you can and incorporate some of those views into your analysis. That's it for a tutorial on stock pitches, how to find companies with limited time, screen for them, and then pick the best one. Hopefully now you know a bit more about this process and what to do if you're in this position and you need to come up with a stock pitch very quickly.